You're listening to the Syndicate Room, the AI-generated podcast from AdValorem Syndicate. Everything you hear, the research, the scripts, these voices, all produced by artificial intelligence. We believe in full transparency.
Different hosts every episode, same sharp analysis. Let's jump in. The big question this week: is Anthropic about to dethrone OpenAI?
OpenAI hit $25 billion in annualized revenue as of February. 17% jump from year-end. Impressive, right?
Impressive until you look at Anthropic. $19 billion annualized. They were at $4 billion mid-2025, nearly 5x in under a year. Epic AI projects a crossover by mid-2026.
The driver is Claude Code. $2.5 billion run rate. 500-plus enterprise clients, each spending over $1 million per year. Enterprise is where the real money is in AI.
But here's the contrarian take. Growth rates this high always slow at scale. OpenAI still has ChatGPT, the Microsoft distribution. Anthropic hasn't proven they can sustain 5x growth past $20 billion.
Fair. But two AI companies with combined revenue approaching $50 billion, neither one public? The pre-IPO secondary market for these names is one of the most interesting trades in venture.
Especially when the SEC is actively discussing expanding who counts as accredited. When Paul Atkins tells the All In podcast that changing accreditation rules is on the 2026 agenda, that's a signal.
Okay, topic 2. The SaaS bloodbath.
This is the creative destruction moment everyone talks about in theory, but nobody wants in their portfolio. AI agents are replacing entire categories of software: customer support, data entry, code review. If your SaaS product does something an AI agent can do for 1/10 of the cost, your multiple is going to zero.
But the flip side, companies building AI infrastructure are printing money. Cerebras raised $1 billion at $23 billion. MatX raised $500 million for custom AI chips. The silicon layer wins, while the application layer bleeds.
And this is where warrant investing gets interesting. When SaaS companies go through distress, when accelerators fail, the warrants become available at deep discounts. It's the crash investing philosophy in action.
AdValorem has two active positions here. The new chip warrant portfolio with warrants from over 1,000 startups, and the accelerator warrant enforcement platform, a systematic approach to extracting value from distressed accelerator assets.
Warrants give you capped downside with full equity upside. If even 5% of 1,000 companies achieve meaningful exits, the portfolio returns can be extraordinary.
Let's pivot to accredited investor rules. Under SEC Rule 501, you need 200,000 income or $1 million net worth, or, and this is the update most people don't know about, you can qualify by holding a Series 65 license.
That credential pathway is huge. Study for the exam, pass it, and suddenly you have access to private placements and syndicate deals. AdValorem covers this in their education library at gp.advalorem.io.
And if you're already accredited, AdValorem is deploying across 5 verticals: AI robotics, quantum computing pre-IPO, warrant portfolios, energy infrastructure, and warrant enforcement. Applications open at gp.advalorem.io.
They also host investor dinners, have an active Discord, and publish daily research on the LP portal.
That's our show. The Syndicate Room, Monday, Wednesday, Friday. This is an AI-generated podcast. The intelligence is artificial. The opportunities are not.
See you Friday.